Oh, coming up, you hit it. Coming up on Talk Your Chart 21, Marcos positions the consumer as the saving grace to execute the Fed's soft landing.
Ooh, that's a prediction?
Ooh, oh God, no, I'm not good at those. Speaking of predictions, who's winning, Verizon or Exxon? Who did you pick? I didn't remember who you picked.
I would start off with, I think most clients would look at this, and if this was in their portfolio, they'd look at it and say, well, JP Morgan Chase did the best over the last few years, and so I want to own more of that, and I want less of Verizon. So I'm going to take the exact flip side of that. I'm going to take Verizon, which I think had the worst performance on that chart.
I'm going to say, and again, this probably has nothing to do with anything, with rates going up next year, Brett, when interest rates go up, what segment of the economy benefits when rates go up? Financials, baby. Give me JP Morgan, give me Jamie Dimon over the next 12 months against your Verizon. It's JP Morgan versus Verizon. I'm pretty much 100% positive you're crushing me.
I wish I had picked ExxonMobil though.
Yeah, I know. That's called hindsight. Hold on, let's see who's winning year to date. Oh my gosh. I have some ground to cover.
This is like the third quarter of an NBA basketball game. You don't get concerned yet because the team could come back with a major run.
I know. It's a game of runs, BH. It's a game of runs. Just strong drawdown Q1 did not help me out. So we have JP Morgan down 21% on the year, Verizon down 9% on the year. Rates are going up. Come on, you silly financial.
It's factored in already.
Hold on, dude. No, but man, and I am. All right, welcome to episode 21 of Talk Your Chart with Marcos and Brett. Today, Mr. Horowitz, I'm talking about cash, cold hard cash.
Paying higher rates finally.
I know. I don't know what my savings account is paying, but it's more than 0.5%.
It's time to get excited about hitting 1%.
I know. The good thing about bonds being down as much as 10% this year is that they'll be better moving forward, right? Is that the good part?
Presumably, right? I mean, they've come down a lot in the last month or so. I think we're at 3.5 on the 10-year was what we hit as a high. And now we're in the 2.7, 2.8 range.
Yeah, it's bananas what the 10 years has done. It's at 2.8 now. I thought we might finish a year at 3.5. I don't think that happens. We'll see. And now we're worried more about recession than we are inflation, but we're digressing. Let's get back to that cold hard cash I was talking about.
One thing though, I think you and I just discussed it before this call started recording, that we've only had one inflation number that was lower than estimates, right? We have to have a second even before the Fed meets next month. So I think we're all maybe a little bit too optimistic that, hey, this is the end of inflation, rates are coming down, the 10-year is not going to spike. Like next month, it can go the opposite way and we're back to where we were.
Oh, look, I totally agree with the fact that the market might be too exuberant and perhaps didn't listen to the same Fed minutes or Fed chairman that I listened to, who said, we'll go 75 basis points or 1 point if the data says that. Right. We get the benefit now of 2 prints before they meet again in September, right? Because they'll have this one in July and then August. That said, and we said this a second ago, going from 9 to like 6 and 5 is way different than getting down to what Jerome said of 2 or 3. I don't know how the hell that happens without a ton of people losing their jobs. If you look though at what 30% of the CPI prints are, it's a lot of energy and that's rolling over. So it would just make sense if we peaked in June. That's all. So I just wouldn't be surprised.
Either way, cash is going to have a negative return for a long time to come.
But it doesn't work, man. Unless you were sitting on cash and planning to travel to Europe, didn't necessarily work out for you. I'm going to get back to this cash chart that we're looking at and why the heck I brought it up.
What you see from this?
So look, why I brought this up, and it's a simple talking point. This was one of the first times I saw the XX say, everyone knows that people have been saving more from the first quarter of 20 to the first quarter of 2022 because of all the stimulus, right? That's come out. fact that that's happened. This was the first chart I saw that showed me, again, divided by income group, what that savings actually looked like, and that cumulative total, which was in the trillions of dollars. In this case, it's telling you just shy of $3 trillion of additional savings, which is perhaps why we've seen such a resilient consumer up to this point. And ultimately, is this perhaps what helps or maybe hurts, but I'll make the argument for this helps, the odds of a soft landing being architected by the Fed. So we know a couple of things looking at this. Personal savings has come down, and they are drawing from that $2.7 trillion. That's coming down. We get that 100%.
It needs to come down, right? Like I'd argue this is way too high to have all this money being saved. We talk to clients all the time that have way too much money sitting in cash, either because they didn't spend it during the pandemic because they couldn't spend it, or just because they didn't want to spend it and they liked having that cash there. And now with the market down, they feel comfortable having that. But that number is not good if it just sits there and doesn't move around in the economy.
No, there's no way it's sitting there. And there's no way you have consumption figures as strong as they are without that number coming down. Especially that you do see labor market is still super duper healthy. We get it, but it is tightening a bit. And then hopefully when you talk about labor participation, which is pretty darn low, if this 2.7 comes down, maybe you get a lot of those people who haven't kind of gone back to look for work, because the jobs number doesn't include, at 3.4% everyone's quoting, it doesn't include people who stopped looking for jobs. But the labor participation rate does, because it's dropped. So does labor participation go up as that goes down? And is that going to be helpful or hurtful to what the Fed is trying to do?
Yeah, no, it needs to go up. We need to get more people working. You need to get less on the wage inflation front. You need to get either supply up, demand down, a combination of the two, but in such a way that it's not damaging to the economy.
I hear you. So
very challenging.
I think this helps. The thing is, I can also say why this would hurt the Fed's odds, but I'll go with helps. I think this helps the Fed because you have a consumer, a person who can weather an economic storm or hurricane. Thank you, Jamie Dimon. We have 15 clients a day asking about Jamie Dimon's hurricane. Because you are in a position where you have a savings tailwind. So let this savings tailwind take its course. We get the 11 million of available jobs slowly coming down. It's now under 10.8, I think, which is good. I think the next thing you're going to see, layoffs are so darn low. There's less layoffs now than pre-COVID. So what you're seeing, I think, are employers hoarding employees because you have to pay new ones more.
We're doing it. I mean, we would, if market kept going down, there's no way we lay off staff. I mean, we're already a little bit understaffed as it is. We already want to hire more staff. And so we want to keep our people around, because you hear about businesses all the time. You call them up, it takes an hour for someone to call you back. I've had clients call other brokerage firms and they said, we'll give you an appointment in 3 weeks. Just you need everybody that you can, because you don't want to get. Mm-hmm.
Wow. Okay. Thankfully, we're not a brokerage firm. Good. So anyways, man, this was, how much signal is here? I have no idea, but I do know there's a ton of savings tailwinds that are clearly articulated in this number. What we do know is it's going to come down. As that comes down, you might get increased labor participation.
So let's look at something that you and I have chatted about, I know a few times in the past, which is the biggest US stocks.
Okay. Oh my gosh. Did you give me 3 charts? Are you breaking the rules?
Well, we're going to go through 2 of them really quickly. But the first one, we've talked about it, that the names change every decade. So the first chart here is the top 10 US companies, US stocks. Every decade, you can see how a lot of them are the same, a lot of them are different. But one thing we see now is that most of the stocks that are there in the 2020s are technology oriented, right? Apple, Microsoft, Amazon, Google, Facebook, and we know that because those companies are making a ton of money. They're gobbling up companies left and right. And so their stock is benefiting as a result of that.
Yeah, absolutely. 1930. I'm not going to lie to you. I wasn't aware AT&T was around back then. I just learned that right now.
It's been around for a number of those decades.
I know. So that, to your point though, so 1930, if you looked at by sector, the biggest sector is going to be something industrial. And you look 2020, obviously the biggest sector is going to be technology.
Right. So now let's say we were to go back over the last
25%, by the way, I'm sorry to interrupt you. 25% of the S&P 500 is technology.
It's a big percentage. So if we said, looking at the second chart, let's say we wanted to just pick a basket of big flying technology stocks. So what we have here in the second chart is the 10 largest US technology stocks as of 9 years ago. I'm a little bit suspect why it's 9 years ago and not 10.
Yeah. Data mining, right? Data mining.
Cherry picking. But this chart shows you the returns of these 10 stocks and then how they did versus the market. Did they outperform or underperform? And pretty much split down the middle, half outperformed by a lot. Well, I guess 4 of them outperformed by a lot, and 5 underperformed, and 1 was relatively flat, Cisco. So I think if you say, look, okay, we know technology is big. We know the NASDAQ is this big thing. The companies are making money. Let's just pick some of the biggest stocks out there over the last 9 years. You really have to get lucky in which stocks you pick, because you could get really unlucky in these names.
I know. This is an interesting way to look at it, because obviously it's trying to frame the whole don't individually pick stocks in the tech space, which is timely. The talking point this goes back to is the majority of individual stocks underperform treasury bills.
Right.
That's the problem. I think the other problem is that people think as individual stock investing, when they think about the downside of individual stock investing, they think to themselves, what are the chances that this business goes out of business, right? That it goes from whatever it is to 0. That's not the highest probability risk.
Oh, for sure.
The highest probability risk is actually not that. It's that it just underperforms for decades. And then you end up with 2% annualized returns when the market was doing 9 or 10 annualized.
When I worked for my old firm, most of the executives had Pfizer stock options, and they got them in the late 90s. And by the time I left, and even 5 or 10 years later, most of those stock options were still underwater. And Pfizer is not a small company, right? This is a massive company. They're producing a lot of drugs. They make a lot of money, yet the stock did not move over that period of time.
I know, dude. Good stock versus good company. Somebody smart said that one time.
So I want to now flip to the last chart here, which is over time. I think most clients, when they come in, if they have an individual stock in their portfolio and they say, how is that stock done? They then take that number, whether it's a good number or a bad number, and then extrapolate that going forward. Oh, I've owned such and such stock. Wow, it did 20% over the last 20 years. I'm going to keep holding that. That's done really well. Or, hey, it's down over the last 10 years. That stock did poorly. I'm going to get rid of that. And I think what this chart is showing you is that those big stocks that have done so well over the last 10, 5, and 3 years that have outperformed, the market, how poorly then they do once they become a top 10 stock. And so we feel like those companies that have done well, that have had the huge gains, they're going to do well forever. They're going to keep going up and up and up because they're a monster. Everyone's heard of them. They're never going to be, like you said, out of business. But here you can see the outperformance disappears very, very, very quickly. I mean, the 10 years after becoming a top 10 stock, you're now trailing the market by 1.5%, which you said, underperformance.
Okay. So that's the top 10 stocks performance at 10 years before they were in the top 10?
On the left, right. And then the performance after they became a top 10 stock on the right.
Exactly. Yeah, that's the beauty of market cap weighted stuff. You participate in the momentum, and then you ultimately don't totally participate in the demise. So I get it. So what do you, so I come to you and I have, out of my $5 million portfolio, I have $3 million in Apple. What do I do, Brett?
Trim it. I mean, it's the same thing that we would do with any of our fund positions that had gone up in value. You start trimming the profits, taking the gains off the table. That's what I would tell most people, is that even look at Berkshire Hathaway. I mean, for as well as it's done over its long period of history, every decade going forward has been basically worse than the one before. And so it's not that Warren Buffett's an idiot. It's that he had a lot of great bets over the years. The stock gets bigger and bigger. It's sitting on more and more cash. It's got more competition. And next thing you know, it doesn't perform as well going forward. So that's when people start trimming.
But are you also telling me that my expected return is going to go down if I do that? Because I imagine So you telling me to trim my individual stock position and put it into something diversified?
I mean, no idea what technology is going to do going forward to know whether Apple is going to go into a new market and sell cars, or whether they're going to sell insurance or this or that. But the chart is
Healthcare.
the chart's pretty convincing that whatever happened in the last 10 years, like, you don't just extrapolate that forward, because it's going to be very different the next 10 years. And all that outperformance here in these top 10 stocks completely dissipate over the next 10 years.
Okay. All right. So fine. So I've done that. I've reduced the risk of underperforming the market, because now I'm just investing in the market. But I also, Brett Horowitz, it's not fun for me to talk about your stupid, boring portfolio with anyone.
Index
And
funds.
it's not fun at all. And it doesn't give me the chance to outperform, right? Kind of like by definition, we're going to perform in line with the market, which can be fine broadly. But if I want the opportunity for outperformance, how do I do that?
Oh, but that's where you're wrong. The market is not average performing. The market is outperforming. The market is top performing, right? That's why when they see the statistics that 90% of mutual funds underperform the S&P 500, you own the S&P, you're not average. You're beating 90% of your peers, 95% of your peers, depending on the category you're in.
Well, that I get, but to have the chance to outperform the market, right? So I lose that by being diversified,
Yeah,
which
so
is fine.
Good
Now,
luck
if I
with that.
want the opportunity to outperform the market, how do you think through that?
I think you're fooling yourself if you think you're going to outperform the market.
That's not very fun, Brett Horowitz.
It's not supposed to be fun. This is money we're talking about.
I know.
You want to take
So
a little
wait.
casino account, you play with a casino account, but for most of your money, $3 million, I would say that's not money that you want to play with.
Okay, fine. I get that. And now I think you get it to where the real answer is, which is in position sizing, perhaps, right? So I know Brett Horowitz, the robot from the future, is saying, don't do it. But I would say, because I own a little Apple stock, it's like 0.01% of all of my money, but I still get to say, cool, it was up a really, really big percentage, and I had a chance to outperform.
Well, I could tell you, I also own Apple stock through my index fund, and I got to perform the way Apple did as well.
I know you're an index fund guy. So am I. I know, it's just fun.
We
I
can
think there's
debate
also
this.
lessons to be learned. Like when I gave my son a chance to buy into a company, it was into an individual stock. And I said, fingers crossed, he loses the majority of his money so he could learn from this. He did the opposite, and it did really, really well. But we still have encouraged investing. And now he is in all these index funds because he wants to be. And then he literally takes a small percentage of any money he gets on a birthday and might put it in a fancy little company that he's heard about.
Okay, the reality is, the more, unlike almost everything in the world, the more knowledge and the more research you do on stocks does not make you better stock picking, because what are you betting on? You're betting on the future, and no one knows the future.
I agree with you. Here's another thing. What if you could you build a portfolio that was the worst performer over a 12-month period?
High fees, probably.
No, forget fees, just pure investment performance. It wouldn't be that simple because it's kind of random. So I think about it that way. How much skill is involved versus how much luck is involved. If it'd be really hard to be bad at it, it probably means that there's a little bit of luck naturally embedded in the practice.
A lot of luck, yeah. Our time is up here today, man.
I know. All right, brother. I'm going to go buy some Apple stock. See you later.
Index funds.
I know. Later.